think it's going up. Like I've said, I've got a 21-year view, and my 21-year view is that over the course of 21 years, it's going to average about 29% ARR. It's going to decelerate. It's been growing a bit faster, and it will decelerate to grow a bit slower. I think the past 5 years is like a 37% annualized growth rate. So if it moves from 37% down to 20%, you'll get some blended rate. You'll get a blended volatility. And I think, where are we right now? I think it's oversold. So I would expect that Bitcoin will be much higher by the end of the year than it is right now. But, Bitcoin has a way of making fools of all of us when we try to forecast its 12-week move or 24 or 2-week move. It's a bit above my pay grade. So long term, I am bullish. Near term, I'm also bullish. And in the intermediate frame, I'm sure there'll be a lot of unexpected surprises due to unexpected developments that none of us can anticipate. I think eventually it's going to 20 million, 21 million a coin. It'll emerge as the dominant digital capital of the world.
What if the reason Bitcoin hasn't already exploded to unimaginable levels isn't demand, but the system holding it back? Michael Saylor is quietly revealing something most investors are completely missing. This isn't just about adoption anymore. It's about a structural shift happening beneath the surface. Right now, trillions in Bitcoin sit trapped in a system that forces it to be reused, loaned out, and even shorted just to unlock liquidity. That hidden pressure is suppressing price. But the moment traditional banks step in, when Bitcoin becomes clean collateral, when credit is built on top of it without that hidden friction, the entire dynamic flips. Suddenly, supply tightens, short positions get squeezed, and capital floods in at a scale the market has never seen. This is how you go from thousands to millions per coin. It's not hype, it's infrastructure. And if this transition happens faster than expected, most people won't see it coming until it's too late. Listen closely as he breaks it down.
The global embrace of it is a legitimate asset. So as the Americans, the Chinese, the Europeans, the Japanese recognize it as a capital asset that you can hold for long-term investment or long-term store value, that's a big step. The second step is adoption by the banking system. Right now, the Basel rules heavily penalize a bank from holding Bitcoin. I think if they normalize that so that banks aren't penalized for holding Bitcoin as collateral, I think that would be a big step forward. I think the securitization of the asset, the formation of all these ETFs and the amount of capital flows into it is a third step. I think the formation of bank credit networks, like, there's about 450 Bitcoin a day at 70,000 a coin, 30 million a day, about $10 billion a year in organic supply available for sale from the miners. So call that 10 billion a year is 1 year's supply. That's going to get cut in half in 2 years. Mm-hmm. Every time someone creates $10 billion of credit, they buy the entire year's supply. So for example, my company sold about $10 billion worth of digital credit. We bought an entire year's supply on that digital credit, and that's something we created in the past 12 months. But if a bank like JP Morgan starts to extend credit on Bitcoin as collateral, someone posts 100 billion or 50 billion of Bitcoin, JP Morgan offers 10 billion of credit. That 10 billion of credit is 1 year's supply of Bitcoin. So every $10 billion of credit that's created is one turn on the network. So I would be looking at the formation of bank credit networks and how big they get. Like how much credit will Schwab or Citi or Morgan Stanley or JP Morgan extend on the underlying capital asset? Because the thing that holds the price back is the need to rehypothecate the Bitcoin in order to generate a loan or get yield. So a lot of people, you've got, more than $1 trillion worth of Bitcoin out there that's unbanked in the shadow banking system. So when I need yield, I'm rehypothecating it and someone's short selling it. And when I need a loan, if you want a conventional loan against Bitcoin, you're paying 11, 12% sometimes. But if you went to a crypto exchange, they might give you the same loan for 2, 3%. But the catch is the cheap money requires that you transfer the Bitcoin and they rehypothecate it. So if someone's pledging $100 billion of Bitcoin as collateral in the crypto economy in order to borrow $10 or $20 billion of cash to spend, then you're short selling $100 billion of Bitcoin. So you're short selling 10-year supply of Bitcoin. So I would say probably the thing that's holding the price back is rehypothecation of the underlying crypto asset in the crypto economy. And the thing that will drive the price to the moon is people stop rehypothecating and we call that asset back, we put it in cold storage, and then whoever sold it short has to buy it back and the price moves north. But of course, the reason that people don't do that is because up until now, even today, it's very difficult to get a conforming loan or a conventional loan against Bitcoin. So people are forced into the crypto economy and this dynamic of rehypothecation. So bank credit networks will be very big. I mean, $100 billion or more bank credit could form. And not only will you have less demand to sell $100 billion of Bitcoin, but you will also have people migrating from rehypothecation and non-rehypothecation, and that'll create a short squeeze on the other side. The other dynamic is digital credit. So my company is selling STRC, it's digital credit instrument. So the other, 2-3 weeks ago, we sold $1.2 billion of it. When we sell $1.2 billion of STRC, we buy back $1.2 billion of Bitcoin. And that week, we bought 5 Bitcoin for every Bitcoin mined, or some insane amount. If we sell $10 billion of stretch in a year, we're going to buy the entire supply mined by the miners. When we sell 20 billion, we'll buy 2x the supply. So the formation of those digital credit networks will facilitate a huge amount of capital flowing into the system as well. So I would be looking at all those things. And I mean, the last thing is just volatility in general, because as the volatility in the asset comes off, the creditworthiness of it increases, and then the willingness of conventional TradFi banks to extend credit against it increases. And, if you want a simple analogy, it's like you live in a city, and on one side of the street, it's kind of scary and dangerous, and you have to buy the houses for cash, and there's a lot of crime. And the other side of the street, it's totally safe. There is no crime. And you can get conforming loan from Fannie Mae or Freddie Mac with, a 20% or 10% deposit, and the government insures the loan. And then you ask the question, what's the difference in the price of the houses on one side of the street versus the other side of the street? So when people feel safe and the conventional banking system finances the asset, the price of the houses skyrockets.
Something just changed, and almost no one is paying attention. Michael Saylor isn't just talking about Bitcoin going up. He's describing a transition most investors don't even realize is happening. First it was equity, then bonds, but now we've entered the credit phase. And this is where things get dangerous, in a good way. Because what's really happening is Bitcoin is being transformed from a volatile asset into something institutions can treat like stable income. That shift unlocks a completely different class of capital. Trillions sitting in fixed income markets that have never touched Bitcoin before. And once that door opens, the scale changes overnight. Most people are still watching price, but the real move is happening in the infrastructure behind it. This is where the next wave is being built, quietly, aggressively, and if you don't understand it now, you'll only recognize it after the move is already gone. Listen carefully to how he explains this.
And now we're in the credit stage. Well, actually, there was a middle stage. First, we did equity, and then the middle period was bonds, convertible bonds. We became the biggest issuer of convertible bonds in the world. And we maxed out that market. And now we're in the credit stage where you're seeing the formation of credit instruments like STRC or SATA. And that's really tapping into pure fixed income. And I think that's actually got much greater legs. Like this idea that I'm going to convert a highly volatile 30 AR asset into a non-volatile 10 AR asset, right? That's a very, very powerful idea. And there's no reason why they can't be billions a month and then tens of billions a month and then hundreds of billions a month. And so I've really got my eye on that dynamic. There's two dynamics, right? The formation of digital credit from public companies, and the second is the formation of bank credit networks from the too big to fail banks, right? Those are the two large sources of capital that will drive the next phase of development of the entire network.